go through more of an ACA 101, and I'm going to add a little 0.5 in there too, because I've added a little bit to this webinar for all of you, so it's very specific to Owen-Dunn clients. And we're going to go ahead and get started because I do have a lot to cover. And if there's any questions, I will be taking those at the end. You're welcome to type them in the chat window as we go through, or write them down on a piece of paper, and then if your questions aren't answered as we go through the webinar, you can go ahead and type those in the end. Everyone is muted, and this webinar is being recorded. So our agenda for today, we're going to take a look at what kind of data you need to really dig deep into the mandate and reporting requirements and get going what you need to. And later on today, there will be the webinar that's specifically just for the reporting. So I'll touch on it just a little bit today because it all kind of flows in together, but then later on this afternoon, we'll go more in deep onto that. So we're going to take a look at the basics, the penalties, waiting periods, marketplace exchange notices, measurement, admin, and stability periods, affordability, and reporting. So as just a little disclaimer, I am not a lawyer. I do not work for the IRS, so this is not legal advice or tax advice, nor is it the final thoughts on healthcare reform. As I'm sure as you're well aware, there's a lot going on right now in Washington, D.C. as far as healthcare reform goes. So let's take a look at the data and what you need to get everything together for what we're going to talk about. You need your hire, termination, and rehire dates for employees, so especially the rehire date. It becomes very important depending on where employees are in their stability period or if they're a new hire employee, and we'll get to that a little bit later. Service hours and leave of absence information, benefit information, what type of plan do you offer, how much is it per month, enrollment and waiver information, do you have a waiver on file for employees, do you know who was enrolled or who waived, rate of pay or box 1 wages depending on the safe harbor that you use, dependent information and coverage dates if you're self-funded, information regarding any other person on the plan, including retirees, non-employees, and COBRA participants, again, if you're self-funded. Offers or enrollment of COBRA coverage due to a reduction in hours, and that applies to everybody. So whether you're fully insured or self-insured, you need that information, or self-funded, excuse me. Union employee information. So if you have union employees, you do need the start date, and if you have the benefit information from the union, all the more the better. But if you don't, then definitely have the hire and termination dates for those union employees. Total number of employees per month, including union employees. Total number of employees that are considered full-time under ACA each month. All of this data you need to either comply with the mandate or compile everything for your reporting. Then there's W-2 requirements. So if you have 250 or more W-2s that you file each year, you are required to place data into box 12DD for the contributions to various plans. So where does all this data come from? Where is it housed? I've been working with many different clients across the nation, and sometimes it's in a paper file. So I'm getting scanned documents that I'm going through. Sometimes there's Excel spreadsheets. Maybe you have a payroll system that's separate from your timekeeping system, that's separate from your HR information system. Maybe there's a separate Ben admin system where you track who was offered a plan and when, and who enrolled and who waived. If you have a third-party administrator, since you're self-insured, they're going to have most of the information you're going to need for Part 3 of your reporting. And as we all know, being in those hot seats in HR and benefits and payroll, you sometimes have it just up in your noggin and it's not anywhere else. So all of that information really needs to come together and have some system, some way of compiling it all to not only comply monthly with the mandate, but also to do your reporting. And I am going to continue this webinar as if the mandates are continuing until the end of time and that nothing is going to change, because right now we have to keep the foot on the gas with everything as is, regardless of what's happening right now in Washington. So let's take a look at the employer shared responsibility, also known as the employer mandate, or Section 4980H of the Affordable Care Act. So the basics, what do you need to do? You need to determine who is an ACA full-time employee each month out of the calendar year. Offer an affordable plan that provides minimum essential coverage, minimum value within applicable timeframes to at least 95% of your ACA full-time employees. If you are a smaller organization and that 95% buffer is not more than 5 employees, then you can take a little extra off the top there. So as an example, if you are an organization with 55 employees, per what it states, that 95% marker there, you need to offer coverage each month to at least 52.25 employees. So the IRS is giving you a little bit of an extra buffer to say, okay, you need to offer it to at least 50 employees to be under the regulations for the mandate and make sure that you're complying. So what else do you need to do? You need to make sure coverage is also available to dependent children. You don't have to cover spouses, and you do not have to contribute to children or spouse coverage. It's just the employee-only rate that needs to be affordable. Measure and track all employees. And by all employees, I also mean full-time employees and exempt employees. And I'll get into that a little bit more in detail a little later. But it is in the regulations that everyone is measured and tracked. So during an audit, or if you receive a penalty notice, you may be asked for what's called service hours, which again I'll touch on, for all employees, including exempt, including full-time, including part-time, variable, seasonal, and so on. So make sure you're looking at everybody. Make sure the coverage you offer is affordable based on the available safe harbors. Provide any employee who is ACA full-time for at least 1 month out of the calendar year with a 1095-C form. You also need to take that same 1095-C form and send it to the IRS with the 1094-C transmittal. And I'm going to go through all of that in the webinar this afternoon. So if your benefit plan is self-funded or if you're self-insured, you also need to report everything in Part 3 of the 1095-C form. So that's all plan participants, even if they are COBRA, non-employees, so like a retiree or a board member, all of those people need to be reported that they had coverage during certain months of the year. You need to respond to marketplace subsidy notices and IRS penalty notices when applicable. So the marketplace subsidy notices that you may have received, that was not a penalty notice from the IRS. That was more of a heads up that one of your employees went to the exchange and qualified for a subsidy. You are welcome to fight that and appeal it if you want to, or let it be and let your employee continue, but it's really up to you. But just know it's not a penalty yet from the IRS. The most recent update to the question and answer on the IRS website is that they will start notifying employers this quarter with penalty notices or letters stating that we think you may have been an applicable large employer and should have reported for 2015 and we didn't receive anything from you. So you may be seeing something come in the mail from the IRS shortly. You also need to report those contributions that I talked about on the W-2 if you have 250 or more, and that's box 12DD. So hopefully you've been doing that because that's been in place now for a few years. You need to stay abreast on all the changes happening to the Affordable Care Act, and I expect many to occur over the next few months. Document. It's very important that you document not only what your measurement periods are, but what your benefit plan is, how you determined what your affordability safe harbor is, which one you're using, if you're using different safe harbors for different groups of employees or different measurement periods for different groups of employees. Put all of that in like an audit file. You should have a type of ERISA audit file. You should create one for ACA as well. And also house all of your waivers and those sorts of things in your audit file. Like, when was your open enrollment? What period of coverage did that cover for those employees? If your open enrollment was in November, but the coverage wasn't until January of 2017 to December of 2017, have all of that in one area. So it will not only help you when you have a notice come in that there might be a penalty, but also it shows good faith and it shows that you've been doing what you need to do during an audit. Use technology. It is your friend. However, a little caveat to that, audit your technology because it is garbage in, garbage out. I have assisted technology provider that's national with building their ACA platform, and it's still not necessarily capturing everything because it's very difficult to capture all the nuances of the employer shared responsibility mandate and reporting requirements. So make sure that you're auditing what your technology is basically spitting out for you. If you have the technology that places the correct or places the coding on the forms for you, make sure it's working properly. Make sure that the system is capturing all of your service hours for you. Let's take a look at penalties. So what are they? There's an A penalty, which is the payer-player sledgehammer penalties. Basically, if you don't offer a plan that provides minimum essential coverage, you don't offer it to at least 95% of your employees and their dependents, you're going to have a penalty applied. The penalty is $2,160 per year per employee minus the first 30 employees. So if you have 100 full-time employees, you're going to have that penalty on 70 employees, and it is assessed on a monthly basis. So one month you might have 100 employees that are considered full-time under ACA. The next month you might have 98. So it's going to fluctuate throughout the year. If you missed more than 5%, so if you didn't offer it to more than 95% of your employees for any given month, because let's face it, crap happens, and you might have missed some people, the penalty applies even if the coverage was offered to the majority of your employees. So let's say that someone was hired in October, and then your open enrollment was coming up, and so you're crazy busy with all of that. And let's say, I don't know, 5 people were hired in October. All of them were full-time. All of them should have been placed into a waiting period that was maybe set for January 1st start date, which is also the start date of your plan year for that open enrollment. So in the shuffle of everything, you happen to have missed those 5 employees. Well, if you have 100 employees, well, say you missed 6. If you have 100 employees and you miss 6, you now have a penalty applied for January on 70 employees because crap happened and you missed them. The next month, everybody was good to go, so we can move forward from there. But that's how those penalties are going to be applied. Then there's the B penalty. So if you don't offer a plan that's at least minimum value, which is also known as like a bronze plan, or if it's not affordable based on the safe harbors, and one employee goes to the exchange and qualifies for a subsidy, you have a penalty for that specific employee. Whereas with the A penalty, it was with if any employee goes to the exchange and qualifies for a subsidy, applies to all your employees minus 30. With the B penalty, it is just for the employee that goes to the exchange and qualifies for a subsidy. So it's that subsidy notice that you received from the exchange stating, hey, your employee says that they didn't get offered coverage through you that was affordable or minimum value or minimum essential, and they qualified for a subsidy. What are you going to do? So that is your heads up that you possibly have a penalty coming for that employee. And it, again, only applies to the specific employees that go to the exchange and qualify for a subsidy. So I do have some clients that are fulfilling the A penalty because they're offering a minimum essential coverage or MEC plan, and it's affordable. Or they're offering it to at least 95% of their employees. It's also affordable, but it's not minimum value. So they're rolling the dice for those employees, and they're going to pay this penalty based on each employee that went to the exchange and qualified for a subsidy. So how do we avoid those penalties? Best thing to do is offer an ACA full-time employees an affordable plan that provides minimum essential coverage, minimum value. I keep saying ACA full-time employee because it is based on what the IRS considers a full-time employee within their regulation. So I'm going to get into that in a little bit. It's not necessarily what you classify as a full-time employee for other benefits, but it's what the IRS classifies as a full-time employee, either using monthly measurement or look back. You also need to make that coverage available to dependent children, and again, you don't need to contribute to that. Make sure it's offered to at least 95% of your employees, and it's affordable based on the safe harbors that are available, which are the mainland federal poverty level, the W-2 Box 1 wages of current year not past year, but current year, and rate of pay. So those are all the penalties. But first, what do you do with an employee when they're hired? You need to provide them with a marketplace exchange notice. This is actually a Department of Labor requirement. It's part of FLSA 18B, and it's been in effect since October 1st of 2013. The Department of Labor on their website does provide a sample notice in both English and Spanish. You do need to provide it to your employees whether or not you're offering those employees benefits. There's no fine if you don't do this. However, if you are audited by the Department of Labor, they will probably ask you, have you been doing this? Can you prove it? Who have you given it to? When have you given it to them? So just keep that in mind, that if you're ever audited, this will come up. So classifying employees. If you have any contingent workers or independent contractors, please make sure that they really are independent contractors. It's really important to go through the Department of Labor test and also look at your state definitions, because if those employees turn out to be your employees, that you are the common law employer for those employees, and let's say they worked for you throughout the entire year of 2015 or 2016, so you have 10 of them. All of those are decided that they are full-time employees for you. That then goes back and is applied in 2015 and 2016 to your reporting and mandate requirements too. So it's really important that you make sure that all of your independent contractors really are independent contractors and that you are not looked at as a common law employer, because then you will have penalties when you thought you've been doing everything right and you've met that 95%. If those 10 people end up kicking you out of that buffer that you have of that 5%, you now have a penalty because you had misclassified them. Temporary employees through a staffing agency, please review the contract that you have with them. Make sure it indicates who is the common law employer and also states that you pay additional hourly rate or part of an hourly rate for those employees to pay for their benefits under ACA. It's really important that those pieces are there for you. So a full-time employee under ACA is anyone who is reasonably expected to work 30 hours per week or more, or 130 hours per month. And it's any employee that was placed in an initial measurement period that averaged 130 service hours or more per month during their measurement period. Then there's seasonal employees that may have a classification variable, and then you may have union employees as well. You do need to report on the union employees because they are your employees. And there's some relief there for you that we'll talk about during the webinar later this afternoon. So employee classification here with the full-time. What does the regulations actually state? Again, it's anyone who's reasonably expected to work 30 hours of service per week or more. If the employee is replacing an employee who is full-time, then you're going to treat that new employee as full-time. If the hours of service for employees in the same job description or comparable positions, if they vary above or below the 30-hour average, you can take that into account when looking at this new employee you're bringing on as a full-time too. Whether the job was advertised in your posting on Indeed or Monster or Craigslist, that it is full-time, that they're expected to work, a full-time shift, or 35 hours per week or 28 hours per week. Just take a look at all of that documentation. And then in your offer letter, you should start stating, if you're not already, that this is a full-time position under ACA, that your waiting period is XYZ, or you are in an initial measurement period because you are considered a variable hour employee. You may not take into account the likelihood that the employee may not be with you for only 4 months. So let's say you have a first of the month following 60-day waiting period. If you know that you're hiring this employee as a full-time employee, reasonably expected to work 30 hours a week or more, and you hire them with the expectation that they're only going to be there for, let's say, 4 months, you still need to offer them benefits within that waiting period, even though they're going to be leaving. So you can't take that into account. You can't treat them as a variable hour person just because you know that their job is going to end. If they're reasonably expected to work full-time, you treat them as a full-time employee. So variable hour employee. If you can't determine if the employee is, again, reasonably expected to work, the IRS puts that wording in the regulations all over the place. It's they're reasonably expected to be employed on average of at least 30 hours of service per week. Because the employee's hours are variable or uncertain, then you can start to classify them as a variable hour employee, place them in an initial measurement period, which we'll talk about, and then track their hours for a certain number of months to determine their status. So if you have someone that's a part-time person, or someone that's on call, or someone where you don't know exactly what they're going to be working, like say they're a busser or any sort of service provider, and one week they might work 60 hours and the next week they might only work 10. That could be considered a variable hour employee. What about seasonal employees? Some clients I've dealt with have seasons that last 8 months. They need it last 6 months or less to be considered a seasonal employee. So just keep that in mind if you have any seasonal positions. If the customary annual employment is 6 months or less, you can treat them as a seasonal employee and measure them accordingly in an initial measurement period. If the seasonal employment is extended a particular year, like I am in the Sierra Nevadas, so I'm pretty sure this year, based on the weather we've been having this week, we're going to continue longer than a normal season. So this would be one of those exceptions to a seasonal employee, and it's okay if those employees work more than 6 months. If you have a season that happens, say, in the springtime and another in the fall, those are two separate seasonal positions, and you cannot treat those employees as seasonal employees because there's more than one season in a 12-month period. So let's talk about waiting periods. So we've gone through what we should do, marketplace subsidy, or marketplace notices, classifications, and now we're going to look at what that full-time benefit waiting period can be when you hire someone. So that waiting period is also considered a limited non-assessment period, and that is the verbiage that's used in the regulations for 5 different time frames where someone could be in a waiting period, and a benefit waiting period is one of those time frames. So if you're researching this, you may want to use limited non-assessment period in your research as opposed to waiting period, because you're going to get different answers depending on the verbiage that you're using. So the maximum waiting period for benefits is 90 days, not 3 months. So hopefully all of you have, and if you're using a 90-day waiting period, you are enrolling everyone as of the 91st day. And just keep in mind that it's not 3 months, because months like July, August, September, October, November, December are 92 days. You can add a bona fide 30-day orientation period. There's lots of rules associated with that. And if you do that, you want to make sure that your plan documents follow the information, that your employee handbook follows that your offer letter follows this verbiage, and you use that you have a 30-day orientation period plus a 90-day wait. Do not ever state that you have a first of the month following 90-day waiting period, because you are out of compliance when you use that type of verbiage. So you must offer coverage by the first of the day of the 4th month following 3 full months of employment, and you only get credit in the reporting and for penalties if you offer the plan to the employee for every day of the month. So for those 90-day waiting period groups, let's say you offered a plan and the 95th day is today. On your reporting for 2017, you cannot show an offer of coverage for January because you have not covered the entire month in that offer. The offer of coverage would start in February. So service hours, we touched on that a little bit earlier. I'm talk about what a service hour really is. So it's all hours worked, which is easy. Any regular overtime, double time, on call that's paid, like they were on call and then they started working while they're on call. So that's going to be an hours worked. All hours not worked and paid. So vacation, PTO, sick leave, holiday pay, any layoff, and on-call time. So if an employee is paid, let's say, a stipend of on-call time over the weekend, you're going to need to figure out what those service hours are. And there's some equivalency methods to use that are in the regulations. So all hours not worked and not paid due to FEMLA, jury duty, military leave. Those hours, let's say an employee is out for FEMLA. They've exhausted all of their PTO or sick leave or vacation, but they are still out due to that qualifying condition. They're not being paid for, let's say, 6 weeks. Those 6 weeks still need to be tracked and be part of their measurement period, which I'm going to explain in detail here in a minute. So all those hours need to be tracked and be part of their measurement period. Well, how do you track hours for someone that's not there? You can either use an average of what they've worked so far during the measurement period, or what their schedule would have been. So if they're normally a 40-hour per week person, then you're going to just add in those service hours for those weeks that they're out and they're not paid. So this is where we get back to, where is all your data? Is your timekeeping different from your payroll? Do you have your leave of absence information in a system that's not talking to payroll? Or if you have an ACA module, is everything being brought in to those service hours to track appropriately? You want to make sure that you're capturing all the data, because it could affect your employees and how they're viewed with their status for their next stability period. So if you have anyone that's out due to short and long-term disability, and you as the employer pay 100% of their premiums, you need to also calculate those employees under the special leave rules as well. If the employee pays for the premium, so if it's like an AFLEC plan and the employee is paying for everything, then you don't need to track those hours. So salaried employees also need to be tracked and measured. I know it sounds crazy because they're salaried employees, just like tracking a full-time employee that works 40 hours a week. But it's just per the regulations, it's in there. You're probably going to be asked for it and asked for the information on a monthly basis. The IRS is going to want to see, where are your service hours for all of these 40 employees that you classify as full-time. So make sure you have that data or develop that data and get it going so that you have it going forward. There is an equivalency method to use for salaried employees. So if they're not like clocking in and out, or if they don't have a timesheet where it places hours on the sheet for them and then rolls into whatever program you have, you can use an equivalency method of what they probably work, but it can't be less than what they really work. So for let's say part-time exempt person, if they normally work 100 hours, you can't use 80 hours in a month. You need to use 100. If you have employees that have overnight travel, you may need to capture those service hours for when they are away from home, not necessarily under travel hours under FLSA, but could still be a service hour under ACA. And the regulations does touch on this very briefly. And they only provide like really one example, and that's for airline employees and how to do an equivalency for them. So take a look at that if that affects you. Adjunct faculty, if that applies to you, there is an equivalency method to track service hours for those individuals, and it's 2.25 hours per hour of instruction or any other reasonable method. There were other reasonable methods that, well, at least I found reasonable, that were presented to the IRS, and the IRS shot them down. So I would suggest to stick to the 2.25 hours just to be safe. So measurement, administrative, and stability periods. I'm going to focus on the standard and ongoing one first. A measurement period. You need to establish this even if you only have full-time employees. Again, I know it sounds crazy, but this is making sure all your ducks are in a row. So it can be 3 to 12 months in length. It determines who is eligible for benefits in the ongoing stability period. You need to take into account those breaks of service that we talked about. And rules apply when you're changing the plan year. So if you have changed your plan year by early renewing in the past, you may need to look at how your measurement periods have been set up and make sure that things are flowing properly and that you've documented, here's what we did, here's what we're doing now, this is how it affected these employees, and we took care of it in this way. So again, it just goes back to document, document, document. The more that you can show that you're documenting things in an audit, the better off you're going to be. If you don't document it, it never happened. Administrative period. Again, you need to establish this even if you only have full-time employees. It can be no longer than 90 days. Again, keep in mind that if you have a 1-1 plan year start, your measurement, or your administrative period cannot be October, November, and December, because that's 92 days. So most clients have found that 2 months is plenty, because it's just time that's set aside to determine who is eligible for the plan. So you look at all of your employees that have been with you for your measurement period. So if you're taking a 12-month measurement period and you have a 1-1 start date for your plan year, you're going to look at November of 2015 to October of 2016. Then November, December of 2016 is going to be your administrative period. Any employee, regardless of status, that hit an average of 130 hours of service or more from November of 2015, October of 2015, no wait, sorry, November of 2015 to October of 2016, if they hit 130 hours of service or more, then they are offered coverage for an enrollment starting 1-1. So again, that's November of 2015 to October of 2016, because November, December of 2016 would be your administrative period. And then your stability period, which is next, would be January to December, which is your plan year. This is also the time for open enrollment, and everyone must be enrolled by the beginning of that stability period, which can't be shorter than the measurement period, can't be less than 6 months, and must match your initial measurement. There are special rules if an employee changes jobs. So if they go from full-time to part-time and they're in a stability period, separate rules apply than if they're not in a stability period and how you treat them. There's also breaks in service rules and how you're treating those employees when they come back, and if they're in a stability period or not, if they were offered coverage when they left, and it just gets even more complicated with that. So let's say you used a 6-month measurement, 3-month administrative period, and 6-month stability period. You can do that. That's fine, because your stability period is not shorter than your measurement period. The standard that I've seen is a 12-month measurement, a 2-month stability, or 2-month administrative, and a 12-month stability period. So a 12, 2, and a 12 is what I normally see. And that's what we're going to go through in our example. So again, that plan year start, 1/1/2017. We have a 12-month measurement, 2-month administrative, 12-month stability period. So that measurement period, again, was going November to October. You're going to do that every year because this is your standard ongoing measurement period for all employees. So taking a visual look at that, that's what it looks like. That 2-month administrative period, November, December. That 12-month stability period, which matches your plan year, of January to December. So let's look at an example of Joe. Joe was hired July 12th, 2015. Again, using that same 12-month measurement period, November to October. Joe was employed the entire measurement period, and he averaged 130 hours. So in the administrative period, we're going to offer Joe the plan. And he's going to enroll and stay on that plan throughout the stability period, regardless of the number of hours that he works. I'm going to say that again. Regardless of the number of hours he works, he stays on the plan for the entire stability period. There is one exception that I'll get to. Otherwise, keep those employees on the plan for their stability period, regardless of the number of hours that they work. There's a 13-week rule. So how do you treat employees that leave and come back to your organization? Well, if the break in service is less than 13 weeks, it's not 4 months, it's 13 weeks. So you really need to count it out on a calendar. And I have not seen a platform that is able to pull this information very easily, very well, and have it do it for you. So again, this is one of those audit your technology. Know what's going on with your employees. Know what's going on with your ACA platform that you've purchased, and make sure things are running properly. So if there's a break in service that's less than 13 weeks, you treat them as if they never left. So if they're in an initial measurement as a variable hour employee, which we'll talk about here in a second, then that initial measurement continues. So if they left and they had only 3 months in and they come back 2 months later, then they're now in their 6 months of initial measurement period, and that's just the way it is. If they had an offer of coverage because they were a full-time employee and they're returning as a full-time employee, you need to offer them coverage by the first of the month following their rehire. If the break is more than 13 weeks, you can treat them as a new employee. So they're in a new waiting period, they're in a new initial measurement period, and it's like they are a brand new employee starting with you. Educational organizations, so school districts, universities, they have a 26-week rule. So keep that in mind if that applies to you. There's a rule of parity, which rarely anyone uses. I just wanted to throw it out there so that you're aware of it. If an employee originally works less than 13 weeks prior to termination, then you can see if the break in service is more than the number of hours that they worked to determine how to treat them when they come back. So if the employee worked 4 weeks, then had a break in service of 5 weeks, you treat them as a new employee because they were gone for longer than they had worked for you. If they worked 4 weeks and the break in service was 3 weeks, then you treat them as a rehire employee and continue as if they never left because their break in service is less than the amount of time that they worked for you to begin with. So let's look at an example of a termination and a rehire. And again, I'm going to pick on Joe. He was hired back in July 12th, 2015. He terminated in May of 2017. So I'm going to go in the future a little bit in my crystal ball and also show that he rehired on July 28th. Well, May 12th to July 28th is 11 weeks. So we're going to treat him as a continuing employee because that break in service was less than 13 weeks, and he has that offer of coverage first of the month following. The regulations state that you need to offer that coverage back to the employee that's rehired as soon as administratively practical, but no later than the first of the month following their return. And again, if you miss that, it's part of that 5% buffer that you have. Let's say that he came back on September 14th. Well, that's greater than 13 weeks, so he's placed in a waiting period, or that limited non-assessment period, which is first of the month following 60 days. So he would have that offer of coverage December 1st. Well, what happens if Joe has a reduction in hours to part-time? Joe is in a stability period because, again, as you remember, he hit that 130 hours of service in the prior measurement period, November 2015 to October 2016. So he's in a stability period, and he should have an offer of coverage regardless of the number of hours that he works. There's a little tiny provision in the regulations that states you can measure someone for 3 months after a reduction in hours to determine their status and then remove them from the plan if they're under 130 hours of service per month. So he had the reduction, those 3 months, we removed him October. Well, here, there was no immediate reduction in hours. So in July, he worked 120, but then August, he went back up because he came back in a little bit more to fill in for someone who was on vacation. So we start that measurement again for those 3 consecutive months to see if the average is under 100, or excuse me, to see if there's under 130 hours of service for those 3 months, and then we can remove them from the plan. Some companies have decided that this is just too much of an administrative strain, so they just keep them on to the end of the stability period. However, Joe still needs to be measured again in the standard ongoing measurement period that in this example is November to October of every year to determine the status for 2018. So for Joe, he had 134 hours of service on average between November of 2016 and October of 2017, even with this reduction in hours up here. So he does need an offer of coverage starting January 2018. So in this case, we would have just removed him for December, and in this case, he would have been removed October, November, December, but yet given another offer of coverage in January 2018. Again, all of this flows into that 5% buffer. Any audit, any penalty notices, you're going to need to prove that you've offered benefits on time, every time to every employee. How scrutinized they're going to be remains to be seen. I have no idea, but I'm just letting you know what the regulations state and how you're supposed to treat these employees. So let's say John was hired July 12th, 2016, and he had a full-time to part-time type of process happening with him. So he moved positions, or he just decided that he wanted a reduction in hours for whatever reason. Maybe he was going to start to retire soon. So again, the 12-month measurement, same as always, November to October. Reduction in hours in January. Well, John is not in a stability period because he hasn't been employed for one full measurement period, November 2016 to October 2017, because he started in July. So, sorry, that's a little, let's say that's December, sorry, of 2016. He's not in a stability period because he has not been employed that entire time. You can remove him from the plan effective February. So they say there's a reduction that happened in January, we're going to remove him in February. We're going to measure again during that ongoing standard measurement period to determine the status for 2018 and go from there with John. So COBRA continuation. If there's a reduction in hours, you do need to report the offer of coverage that was given to the employee on the 1095-C form if you're fully insured or if you're self-insured. The coding could change from what your normal plan code is. So if your normal plan code is, say, a 1E because you offer it to employees, spouses, and dependents, but only the employee enrolled in the plan, so you're only offering the employee COBRA coverage. So you're going to use an entirely different Series 1 code on your 1095-C form for those months. So we've looked at the ongoing and standard measurement, admin, and stability periods. Now we're going to look at what happens for a variable, part-time, or seasonal employee that's placed in an initial measurement period. I do suggest that my clients establish an initial measurement period, even if you only have full-time employees. It can, again, be 3 to 12 months in length. The standard that I see is 12 months because it's just easier. It does determine the eligibility for benefits in the initial stability period, not the ongoing stability period. That's a whole separate ball of wax. There's breaks in service that could occur that could determine if this starts and stops or continues. And following that initial measurement period, there is, again, an administrative period. Can't be longer than 90 days, and if you do use that standard 12-month measurement, your administrative period can only be 1 calendar month. So you have a shortened time frame to get everything done. Because the administrative period and the initial measurement period can't last more than 13 months. So let's say you have someone that's hired on October 1st, and you're starting their initial measurement period on the 1st of the month, which is something that's available to you. That's what most automated systems do, is they start the initial measurement period as of the 1st of the month following hire or on hire. So if you're hiring someone on the 1st of the month, let's say October 1st, their initial measurement period using a 12-month is going to go from October 1st to September 30th of the next year. October of that following year is when you need to review that employee, determine their hours of service that have accumulated over those 12 months. If the average is 130 or more, you need to offer them benefits starting no later than November 1st. On the flip side of that, If the employee was hired on October 2nd, their measurement period can start November 1st. So their measurement period is going to be November 1st to October 31st. The administrative period is still 1 month, but it's all of November with a December 1 start date. So for budget purposes, you may never want to hire somebody on the 1st of the month, and just for ease of use. So just keep that in mind. The stability period will follow that 1 month administrative period if you're using a 12-month initial measurement. The stability period must match the measurement period. So if you have that 12-month initial measurement period, you need to have a 12-month stability period. The employee needs to stay on the stability period regardless of the number of hours that they work. There is no 3-month provision like there is from a full-time to a part-time employee, because this position is already considered a variable hour position. So they need to stay on the benefit plan for the entire stability period, regardless of the number of hours that they work. So if during those first 12 months you use that employee a lot for on-call positions to fill in for other people, and then during their stability period all of that fell off and they're only working, let's say, 20 hours a week, you still need to keep them on your plan, regardless. And I know that sounds kind of nuts, but that's how it works, and that's how all of this flows together. If they change jobs from a variable hour position to a full-time position, there's different rules that then apply if their reduction in hours occur again, if there's a reduction in hours that occurs again. So just take a look at those employees and scrutinize them really well if this applies to your organization. So let's take a look at Mary. She was hired September 15th, 2015. So her initial measurement period is October to September, because again, it's starting the first of the month following her hire date. She has a 1-month administrative period in October 2016, a 12-month initial stability period, which runs November 1st, 2016 to October 31st, 2017. So the initial measurement, initial administrative, and initial stability period. This is all specific to Mary and anyone else that was variable hour that was hired on this date or any time in September. They're all going to flow in the same measurement, admin, and stability period. So let's say Mary averaged 130 hours during that initial measurement period. We offer it to her, and she enrolls. Okay, great. Well, now what? Because October 31st is the end of Mary's stability period, but your plan year is January to December. So what do? Well, you review what occurred in the last standard ongoing measurement period, that same measurement period that you're applying to all your employees. If she accumulated 130 hours of service on average or more, then you continue to offer her benefits. She didn't, then Mary comes off the plan because she's no longer an ACA full-time employee. Then you continue to monitor Mary during each standard ongoing measurement period. So what does that look like here? Let's say that she averaged 128 hours, had no offer of coverage on the opposite end. So instead of offering her coverage here for these months, she didn't hit that time or average of 130 hours, so there's no offer. So then there's a 12-month ongoing measurement period, November to October of every year, which she has now fulfilled and worked through. So during that time frame, she averaged 130 hours. You're going to offer her coverage in November and December with a stability period of January to December. Let's take a look at affordability. There are 3 different safe harbors to use for affordability. One is the rate of pay, there's mainland federal poverty level, and W-2 boxed on wages for current year. The percentage is indexed yearly, so it started at 9.5% and has gone up from there. This percentage starts at your plan year start date. So if you have a mid-calendar year plan, your percentage for affordability will start whenever your plan year starts. So if it's July, if it's November, December 1st, that's when your affordability rate is going to change for both 2016 reporting and then 2017 as we continue here. So rate of pay. This is an assumed wage. There is only one way to calculate the rate of pay, affordability safe harbor. That's taking the employee's rate of pay, multiplying it by 130 hours, taking that amount and multiplying it by, in 2016, 9.66%, 2017, 9.69%. That's it. There's no other way of establishing what the rate of pay safe harbor is. You don't look at 1560 hours, you don't look at or 2,000 hours a year, whatever hours the employee is scheduled to work. You don't take any of that into account. It's literally just their hourly rate times 130 times 9.66%. So in the example of $10 an hour, it's 1,300 times 9.66%. To make the plan affordable for employee-only coverage, you cannot charge more than $125.58 per month. If the hourly rate changes during the plan year, the affordability stays the same. So it's whatever the employee was paid at the beginning of the plan year start. For salaried employees, you take their monthly salary times 9.66%. And that is the affordability calculation for them. So mainland federal poverty level is another affordability safe harbor you can use, and this is also an assumed wage. And what I mean by that is that it doesn't fluctuate throughout the year, whereas W-2 can, and that's what we're going to talk about here in a moment. But the mainland federal poverty level, it's each year divided by 12 and multiplied by the affordability percentage. So in 2016, that was 9.66%. So you're looking at a rate of 95.63. So if you offered employee-only coverage to your employees at a rate of 95.63 per month or less, and you offered coverage that is minimum value, minimum essential, to employees and dependents, you can use the code 1A on your reporting, and you don't put anything in line 15, and you don't put anything in line 16. So if this applies to you, your reporting probably just got a lot easier because you only need to use the 1A code for those enrollments, and you don't need to fill out the safe harbor code or line 15. So if there happen to have been months where they weren't working for you, those boxes will also need to be filled in with the appropriate codes, but otherwise you can just use that 1A. Then there's current year W-2 box 1. This is not an assumed wage because it can fluctuate, and you take a fraction of the box 1 wages for current year when determining affordability for any employee that was not employed all 12 months. Technically, you're supposed to look at the W-2 at the end of the year and go backwards to determine if your plan was affordable for all of your employees throughout the year. That was the original safe harbor, and there were no other ones until employers across the nation said, wait a second, do you have any idea how incredibly impossible that would be? So they created the rate of pay in the mainland federal poverty level. Employers are still using box 1. It can be very useful for certain employees, and it does most of the time create a premium that you can charge your employees that's a little bit higher than their rate of pay and definitely higher than the mainland federal poverty level. But it is a little bit trickier to manage and to watch throughout the year because it again can fluctuate. That box 1 wages, you can't take into account like 401k contributions and anything else that was like a pre-tax. So that's going to affect those wages for your employees. You can include tips in box 1 in your calculation, but do verify your compliance under state requirements as well. So like in the state of Nevada, the premium can't be more than 10% of box 1 wages, not including tips. So we have 2 different things to look at here in Nevada. And I'm not sure of other states. I know California doesn't really have anything on the box 1 wages issue for benefits, but just keep that in mind that you're complying with both federal and state requirements, and possibly local too. If you're in Pennsylvania, there's that possibility. So when it's more than just the plan that you're looking at for affordability. Notice 2015-87 had opt-out payments listed. So if you offered a plan to an employee but said, if you waive it, I'm going to pad your paycheck with an additional $300, that's considered an opt-out or a cash in lieu payment. Health reimbursement arrangements. So if you have an HRA within your organization, or you contribute to the employee's medical FSA plan, those contributions or that opt-out credit could affect line 15. I go into this in more detail this afternoon, but if you're not able to make that webinar, just read that notice. It's just type in 2015-87 into Google and it'll pop right up so that you can read the rules associated with all of those pieces. And it's not necessarily final regulations yet. These are proposed regulations that the IRS is asking us all to follow. So with that, I'm going to open it up for some questions and take a look at the chat here. So if you have any questions, please do type them in the chat box. Don't be shy. Is there anything you would like me to review further? Is it all a jumbled mess? You're welcome to write that too. Let's go ahead and chat away. What was the document that had to be handed out? Okay, that is the marketplace exchange notice. So I will go ahead and try and bring that up here. And I do believe copies of the presentation are going to be available to Owen-Dunn clients. And yes, I can make the slides available as well. I know that there's a recording that will be available. So marketplace exchange notice. I believe that this exchange notice is only in effect, yet, but it expires at the end of this month. So yet another thing you need to watch out for. This is available in both English and Spanish. It's letting your employees know that the exchange is available, what you offer or don't offer to your employees, who the coverage applies to. So if it's only some employees that are eligible, like those that work 30 hours a week or more, if you offer coverage to dependents or not, if minimum value it was met, all of this information here are questions that the employee receives when signing up for benefits through healthcare.gov or through the California Exchange. There's additional information here that you can complete regarding when the plan will start for that employee, how much it will be, whether your plan year is coming up soon, and how often you take those premiums out. So all of this information, if you have it in your offer letter or as part of your employment paperwork, that will also be sufficient. This is just a model notice showing what should be covered in your information that you give out to your employees, and you're welcome to just use this in place of that. I'm not sure. The question was, is a marketplace notice distributed by the broker? Fernie, I'm going to try and unmute you here because but I'm not sure on that. And actually, Mike, I'm not able to unmute Fernie because I am not the organizer.
Hi, this is Kim. I'm the one that asked the question about the marketplace notice.
Susan, I'm having a really hard time hearing you because there was a bunch of beeping.
Yeah, I don't know. Can you hear me at all?
I still hear the beeping. Can you type it in the chat window?
Yeah, I certainly will.
Okay. And the answer to the question that does the broker distribute this notice, and Fernie said yes, that they do include the notice with their mandated documents. And just so you know, you have an excellent broker, because the brokers I've worked with, other brokers do not do that at all. So kudos, Fernie. Thank you. Any other questions about what was covered? I know it was a lot. We have some time, so I can go back through some additional sections if needed. Just going to keep it open here for a little bit. Do you have any real world examples that you want to run by me of people that you hired and you're not quite sure what to do with and how to treat them, and or if there was a change in status? Okay. So on affordability. Okay. So on affordability for rate of pay. This right here, so you're asking me to clarify what this 125.58 is. So whoops, based on the affordability safe harbor for rate of pay, for an employee that makes $10 an hour, at 9.66%, which is the affordability rate for 2016, based on the start of your plan year, you cannot charge more than $125.58 per month for employee-only coverage to your employees. So if the plan for you is, let's say, $300 a month, you are picking up $174.42 of that premium, and the employee is paying $125.58 per month. So if you are on a biweekly schedule, that's $57.96 a pay period. Does that clarify what this is here for you? Thanks. Okay, perfect. Good. You're welcome. I don't believe it's too late to sign up for this afternoon's reporting seminar. There's also another one next week on Wednesday as well. Any other questions? If your lowest paid employee is more than $10 an hour. The math, yes. So the question is, if your lowest paid employee is more than $10 an hour, then the math is adjusted, and yes, that's correct. So as a fail-safe, you can take your lowest paid employee and apply the rate of pay to that employee, which would then satisfy affordability for all employees. So let's say your lowest paid employee, I think, I'm not that up on California minimum wage anymore, but let's say it's $8.25 an hour times 130 hours. We're going to multiply that rate by 9.66%. So the maximum that you can charge someone that makes $8.25 an hour is $103.60 per month. So $103.60 times 12 divided by 26, you're looking at $47.81 pay period on a biweekly. And yes, this is only for medical that the affordability applies. It's not for dental or vision. So it's only the medical premium that you need to worry about, and it's only the employee-only cost. So if you offer, which you should be, offering a plan to dependent children, you don't need to pay anything for the dependent children. The employee can pick up the additional $300 or $250, whatever it is, or more for that employee's child up to age 26. So you don't have to contribute towards that. You don't have to contribute to spousal coverage, nor even offer it to spouses. You can do a conditional offer, and there is a new code for that on the reporting for the 1095-C. So you can state that, well, I will offer it to your spouses and cover 100% if they can prove they don't have coverage elsewhere. then you're welcome to do that. I'm pretty sure you can still do that in California, but if Owen-Dunn wants to pipe in on that one, if it's incorrect. So reporting is due to the IRS if you're filing on paper by February 28th, if you're electronically filing by March 31st. If you are electronically filing through a software system and you have not used that software system before, I highly suggest that you contact them and make sure that you do not need a TCC code. Most software programs do all of that for you in the background and have already put all of the information in there and done their testing and so forth, but you may need what's called a transmitter control code, or TCC, which means you need to go through e-services, do fingerprinting, go through snail mail with the IRS to get your code. And then you also have to go through testing. So if that applies to you, I would suggest you start that process today because it can be lengthy. You are able to do an extension to the IRS filing of 30 days by filling out Form 8809, and then the employee copies are due to the employees by March 2nd. That was extended from January 31st to March 2nd, and there is no additional extension for those forms to be sent to your employees. So they must receive them or be postmarked by March 2nd. Let me see if there's any other questions. And you're welcome. There is some additional information also on my website, 1095helpdesk.com, under, I think it's called links you can use. So if you need to take a look at those notices, I have them posted there as well, and instructions and forms are all out there too. Let's see. Okay. So there was a question about kind of whose responsibility is this, and I know that brokers play a role in assisting their employers with kind of some basic questions and navigating this, but not many really do all of the reporting. And I'm talking this generally. So again, Fernie or Lisa or Lori, please pipe in if I'm incorrect on any of this. But if you are using a software system, especially one of the big ones like a Kronos or an ADP or a Paychex, you as the employer are always responsible for everything under the employer mandate and reporting. You cannot place penalties on a third party, including the software system, your broker, your CPA, your bookkeeper. It's your responsibility. And those pieces were built into the regulations. It's actually in there that the penalties cannot be shifted to a third party, which is why I suggested that you audit your technology. You audit what's going on. You know what's happening with your employees, and you know what codes you need to report on the forms, because it's very important that you understand what should be there and that you can back it up if you're audited or you receive a penalty notice. And that's all part of that audit file and documentation that I kind of touched on throughout the webinar. So if you're using one of those, especially the big ones like a Kronos, ADP, or Paychex that kind of fills in those boxes for you, I suggest you really look at those boxes closely. This year is definitely better than last year as far as what codes appear and when they appear and why they appear for software companies across the board. It's extremely difficult to take all of the pieces and have the system really use the logic to spit out the codes. I know it sounds like it should be simple. Being on the other end of that, it's really not. It took months upon months of discussion and trying to figure things out, and then there's a whole coding process that goes along with that. So just keep in mind that it really is your responsibility. Your broker may assist you with certain pieces of it. My business was started to take over everything for employers because I saw that need while working at the software company assisting employers with their processes. and getting all of their information into the system, because most of the software providers that you're going to deal with are going to ask you, what's your measurement period? I have no idea what my measurement period is. Okay, well, here's what a measurement period is. You need to tell us what your measurement period is. And so it just goes back and forth like that. That's why I stepped in and created my business in July and left the W-2 world to do this for clients. So I hope that answers your question. If it doesn't, please pop some more in there for me. And also, please reach out to Lisa. Sorry, regarding your other question there, please reach out to Lisa on that information. Any other questions from anybody? If you have any other questions, you're welcome to send them to info@1095helpdesk.com. So info@1095helpdesk.com, and I will get back to you as soon as possible. So if you have anything that pops up, please let me know, and I'm there to assist. Other than that, I don't see any other questions. So thank you very much for your attendance today, and I look forward to seeing most of you this afternoon. Thank you.